It is from the US, a good handover. The Asian markets are pretty mixed this morning.
Reports for the Nifty come in at about 19,200, which is the August lows.
The story of inflation and bond yields in the US, which is clearly negative.
Largely an inline set of numbers for Torrent. Revenue was up 16%.
But Sonal Srivastava, well, she's resigned as a CFO due to personal reasons.
Good green opening across indices.
I think the breadth is getting a little worse.
So the demand is quite good, and we feel that merchant tariffs will be elevated.
Remember, for Delta Corp, between September and October, there have been GST demands worth nearly 23,000 odd crores.
Strong results considering it is a seasonally weak quarter.
Number of hires on a 6 months basis, it's very difficult to kind of get the survey.
Flat on the screen right now on the Nifty and the sensex, but we're off from the session high.
Now, as far as India is concerned, it's pretty positive out there in terms of the feedback. There's high levels of interest among allocators.
And there have been some tense words exchanged between the UN Secretary General and the Israeli Foreign Minister.
Well, this is turning out to be quite the ugly afternoon. Markets have fallen for the 5th consecutive day.
Well, that was the day so far. You're with us here on a fresh new edition of Closing Bell. We're coming to you live from the CNBC-TV18 Multi-Rosefal studios. I'm Prashant. With me, my colleague Reema, and Surabhi should be with us in just a bit from now. Reema, hi.
Hi.
Good afternoon. Starting a little early. The market is looking a little nervous out there. And I think as we speak, though, there is a bit of a recovery which seems to be setting in, right? There you go. That's the intraday that I'm referring to. So the low was made at about 116 or so. And since then, over the last 1 hour or so, attempts at a bit of a recovery is what we are seeing.
It's about a 90-point recovery.
Yeah.
The low is 19,074.
Yeah. Yeah.
So we are looking at a 90-point recovery.
Yeah, 90-point. It was looking, even half an hour back, things were looking a little, but deep in the red. It's not so much anymore. Let's just look at, run through the indices intraday. The Bank Nifty should come up next. I think you're seeing the recovery is shallower as compared to the Nifty, but here also we've seen, a pullback. The low was 42,808, and we're at about 150 points off that level. The mid and small cap part of the market will come up next. Again, a recovery. The low was made again at about 116 or so, and the low was about 38,190, and there is a solid 350 odd point recovery on the mid cap index. And I think similar is the case for the small cap part of the market as well. 115, 116 odd is the low, and we've seen a pretty decent recovery coming through there as well. Now, just a couple of levels before we go any further. We are, of course, we've been trading below the August lows of 19,200 for a while now, just to go back and look at these sort of levels. Next big support areas for the Nifty comes in at about 18,700 and then 18,500. Hopefully, around 18,700, worst to worst, we perhaps go there and then the market finds a little bit of support and, the correction for now is done. Will we go there? Time will tell, but that's the next big kind of area around which the market should find some support. For the Nifty Bank, on Monday, closed just around the 200-day moving average. That, of course, is gone with today's 0.5% fall. And there's the next supports only come in at about 42,300, which is about 600 points out from where we are trading right now. Mid caps and small caps, I would say. Actually, smaller cap stocks seem to be more vulnerable because there is where bulk of the crazy price action happened, right, over the last many months or so. And I would say not just mid caps and small caps, go down the curve. The SME stocks on the SME board, etc., they're absolute madness. So maybe more vulnerable. I'd leave by saying, and I said this in the morning as well, and it's true even more, markets in the very near term are looking oversold. Look at simple things like the RSI, Relative Strength Index, and I looked at both for the Nifty and the Bank Nifty, and now we're at about 30. So typically, at these levels, the market does start to tell you that it is oversold and there are bounces which start to materialize. We've not got a credible bounce still yet so far in this leg. Hopefully we'll get one sooner rather than later. For now, off the lows, but, there are 0.5%, 0.75% cuts on the frontline indices. Reema.
Well, tomorrow is the October series expiry, so tomorrow is going to be a crucial session. But as you can see on the headline, we've fallen for the 5th consecutive session And the fall started when the Nifty was above 19,800. So we had a near 700-point fall. Now we're attempting a bit of a recovery. You know, we keep expecting that this fall is going to come. Markets are overheated. Valuations are a bit stretched. But when it comes, you always be like, oh, my God, you know, it's quite
I'll tell you, Rima, a lot of people think about it, right? People have been expecting a fall for a long time, and they kind of gave up, right? Because the fall just didn't come. I mean, so many people I've spoken with over the weeks, over the months, right? And the common refrain is "ghatta hi nahi." You know, it's like the market falls a little bit, but it just refuses to follow through with anything, right?
I remember you said that. You remember the September fall? And you thought it was really ugly, and the next day we bounced back.
12th of September.
I think what was very different is that the global picture was not as confusing as it is today. Yes, the yields have pulled back from 5%, but still I think a lot of the chatter around West Asia, I mean, the level of uncertainty has gone up in international markets from the 12th of September. Perhaps that's one big factor.
No, I agree. I mean, these factors, these conditions were not there back then. So this kind of adds to the mix. But, you know, to be always prices follow and then prices lead and then reasons follow. But it'll be interesting. Like on Monday, for example, the institutional flow, both on the DI and FI front, there was nothing, right? I mean, a lot of people were jokingly saying that who sold? Somebody, of course, sold. So I think today it'll be interesting again to track those numbers, whether we are seeing any solid blocks of selling coming through institutions, because they've been big buyers. Not recently, but over the last year and a half.
Absolutely. You know, just a point. I was speaking to Sunil Singhania. That's the latest episode of Market Cafe, which will play out by the end of this week. And again, I think he's in the same camp. A lot of these market veterans you speak to, they say the long-term bull market thesis is not under a cloud or not in question. But again, he's in the camp that says valuations have gotten expensive. The market is not cheap at all. It's fairly valued if you're looking at large caps. But otherwise, a lot of stocks that were just flying high in this 3-month mid-cap party, I think that's where a bit of reality is kind of hitting home in the last few days.
If you remember, on the 12th of September, we had Sunil on.
Yes, yes.
It was the 12th or it was the 11th, the one day before, and then the crack happened.
When the big mid-cap fall was happening.
It was the 12th. 12th is when the 4% falls happened. We had, I remember, Nilesh and Sunil and one more gentleman with us, and
Vijay was with us. Vijay
Kedia was with us, I remember. And a bit of a sort of shake-up. I mean, Monday was a real shake-out. This is looking better and better as we head into the last 60 minutes of trade now. So 19,140 is where we're at.
You know, and just to put the fall in context, 18th of October is when the small cap index hit its high, right? Exactly 5 trading sessions back. From that level, the small cap index has lost 5.5%. But it's still up 28% year to date. So, just put those numbers in context, that even after a 5.5% fall, it's just a drop compared to the kind of rally that we've put in already, a 28% rally year to date. A quick word on the big movers. On the gaining side, it's metals leading the chart. Tata Steel, Hindalco are the top 2 Nifty gainers. Both of them have a gain of more than 1%. You've got a few consumption names which are doing well. So Tata Consumers is rising. Britannia is holding up. State Bank of India is up. On the losing side, Infosys is weak. It's gone ex-dividend by 18 rupees. But even if you take that out, Infosys is down under pressure because it's lost 33 rupees of its stock share price today. Only 18 rupees can be attributed to the dividend. Pharma has taken quite the beating. Cipla, Divi's Laboratory, Apollo Hospitals. All these 3 are down more than 2%, Surbhi.
Oh, yeah, absolutely. There is no two ways about it. On the volume charts, if you're looking at, where there is still pressure, then again, a lot of the PSU names, because that's where the big rally has been in the last couple of months, right? So that's where there is a fair amount of caution. Look at Aircon, look at MMTC, RVNL, IRFC. So these are your typical PSUs. They're cutting across lines. It could be railways, it could be something else. PFC, it's a long list, RailTel. So PSUs are where there is price and volume action on the downside. But beyond that, you have some more names that really stand out. Lemon Tree Hotels. Again, look at Lemon Tree's longer-term chart. It's had a fantastic rally. So perhaps with the caution coming in, there's some profit-taking that is also shaping up. So some of these stocks to keep in mind. Having said that, you have a couple of the metal stocks that are still holding up. Metals, by and large, has been relatively better off today. So whether it's large-cap names like Tata Steel or an NMDC, now that's PSU, but it's metal. So, you're seeing some sort of exceptions there to the rule. Metal stocks holding out fairly okay, and market trying to fight back quite hard as we speak. With that, let's actually introduce the first guest on the show. Mitesh Thakkar is with us. We also have, I think, Rajat Bose joining in. So let's talk technicals and levels first. Gentlemen, good afternoon. Thanks for joining in. So let's get your sense on, how to navigate this volatility. We have Rahul Sharma also with us, along with Rajat Bose as well. Welcome to all three of you. Rahul, let me start with you. Levels today, the Nifty came precariously close to 19,000 itself. What is the next zone to track?
Yeah, so, finally we are seeing capitulation on the screen. So this is coming after 4 weeks of sideways range, and once the 19,400 broke in the last two sessions, clearly this is indicating that we are approaching the fag end of this downward corrective move. Now, there are two things to keep an eye on. One is the technical level, and second is the data, which, is indicating a possible bottom. So on the technical levels, 18,900 seems to be, the favorite sort of, psychological Fibonacci level as well as a technical level, because that was the breakout point once we broke out from the multi-month range that we were in. So 18,900 technically. And as far as data is concerned, there are two data points which have turned extremes. One is the Nifty RSI has gone close to 30. Every time this has gone below 30, it has been a good value buy. Secondly, the put-call ratio of Nifty has gone below 0.7. So anywhere between 0.6 to 0.7 is we've seen Nifty forming the bottom and then a recovery happens. We're waiting for one more of this data to happen. May happen tomorrow with the F&O expiry, monthly expiry coming up. If the rollovers are on the lower side, which is lesser than 3-month average, that would indicate that eventually the shorts have got the hard landing that they were looking for, and the retail, which was primarily short, is out of the market. So if the rollovers are on the lower side in tomorrow's expiry, we would very well call for a bottom and expect the Nifty to see a gradual recovery from these levels. So my sense is, it's best to wait out for the 18,900 level or for these data points to turn extreme. Two of them are already at an extreme. If one or two data points like FI long-short ratio or the rollover data that we are closely tracking, if they happen to say so, I think we are very well, looking at capitulation into the market.
Mitesh, same question. Are we staring at a capitulation? We've spoken in the past. We know you've been bearish and cautious in the markets, but that's more of a near-term approach, right? The strategy for the next 1 or 2 days. But if you had to look at this with a longer horizon lens, are we in for a much, much deeper correction, particularly in the broader markets?
Good afternoon. So if I was to look at today's scenario, I think the way my understanding goes is that in the short term, now, and Prashant was also highlighting this based on RSI, I would not give too much of weightage to the RSI. But the put-call ratio, yesterday was around 0.7, and typically you've seen around 0.65 or below that levels. We at least make a temporary bottom in many of the cases compared to an RSI hitting 30. So that is a much stronger indication for me. We are oversold, but the medium-term, long-term structure for me has turned very negative. The indicator setup has turned negative. The Bank Nifty, for example, getting below this lows of 43,400, 43,200 zone, which was a pivot on the weekly chart as well as a 200 moving average area, confirms some kind of a double top on the weekly basis for Bank Nifty and suggests that we are getting into a bearish mode when we see series of higher lows and lower lows and lower highs. So in that sense, I think, while we get a bounce back from these oversold levels one of these days, my belief is that the Bank Nifty is poised towards sub 42,000 levels. And, in the worst case scenario, even 41,500, 41,600 is what I've penciled in. And similarly on the Nifty, closing below 19,200 would be a fresh swing breakdown. And, last time we kind of managed to hold 19,230 and we have filled the gap as well. And then, we'll possibly decline to about 18,700 levels. God forbid something goes further wrong from there and the long-term charts weaken further, then I think I'll look at much lower levels. So I think for me, next 2-3 months will be choppy and downward bias, though in the short term, I would want to see some kind of reversal happening on the hourly to hourly charts before even thinking of covering our short positions, purely because of the fact that the derivatives data indicates we are on the oversold levels. But till I see an action on the price, I'm not in a hurry to cover my short positions.
Okay, so first, Mitesh, 18,700, right? First kind of stop around where you expect the market to get to. Rahul, what was that level for you from here, near term?
8,900. 8,900 on spot.
Okay. And you think it'll be will reverse from there or no?
No. So I think my sense is we should reverse for sure from 18,900 odd. Now a bounce back could easily mean 400, 500 points on the upside. So my sense is we are getting into oversold territory. 18,900 should where one should look for initiating long positions.
All right. Rajat is also with us. Rajat, good afternoon. Speaking to you after a while. What are your thoughts?
Yeah, good afternoon, and thank you for having me. I would say that my reading is that, if we were to close below 19,250 this week, then probably we would confirm the double top. 19,991 was on 28th of July and 15th of September, 2222. These are the two intervening tops, and the bottom, the closing price bottom was 19,250, around that level. If that gets taken out, then there is a clear double top formation that is confirmed as per Dow theory. And now that the moving averages are giving bearish crossovers, meaning that shorter term moving averages are piercing longer term moving averages. Precisely, I would like to refer to 9, 20, and 50. They are suggesting that after this week, you are going to get a rally. You're going to get a rally that is you call it a corrective rally. Later on, you call it a suckers rally. Whatever be that, I would suggest people should use that opportunity. That rally might scale up to something like 19,600 kind of levels, and after that, it will fall again and pierce the lows that we make either today or during this week. Actually, we are headed down. And I have studied monthly charts, I've studied weekly charts, and I have seen that most stocks are showing topping out formation. Say, I'll give you a small example. Either you take, say, an SRF, which has shown a huge distribution for a long period of time. That industry, as it is suffering because the input costs are going up and the finished goods prices are going down. So such kind of problems are there. You will take it Linde India, a great company, a great stock so far, but it is showing topping out formations. N number of that kind of things. Only some metal stocks and certain other stocks like, say, some seed stocks like Kaveri Seeds and all, they may bounce back, but more or less, I agree with Mitesh that over the next 3-4 months, we are likely to see some kind of a downward movement. And Prashant, you would recall that 2014, the election rally began in late February. Generally, in election year, before, in the run-up to the election, we see rallies happening. But prior to that, 3-4 months prior to that, we see this kind of corrections happening, not in the same nature. But this time, the problem is that in other phases, say the lemon moment of 2008, when 15th of September to 28th of October, there was a fall at that point in that year. Similar pattern is now showing here, but this time it is at the top and that time it was at the bottom. So after that, there was a sideways movement, and from March 2009, we saw a big rally. So there is a possibility that we are headed down, and I would suggest any rally that you get, exit from those positions that you are not going to hold for long term, and those stocks that are not fundamentally sound.
Got it. Gentlemen, good speaking with all of you, and good to get that perspective. And thank you for joining us. Rajesh and Rahul and Mitesh. Mitesh will, of course, come back to you for some trading ideas as well in a bit from now. For now, we have to take a quick commercial break here. I think we're down, 140 points at 19,140. So no, not very different from where we were when we started. We'll take a quick break here. Manish Singh of Crossbridge Capital will be joining us on the other side. Prakash Diwan will be with us as well as we get into the final hour of trade. Stay with us.
Welcome back. The bears are not just ready to give up their grip on the market. The attempted recovery, the attempted pullback that we were staring at about 215 is now once again petering off. The Nifty went to levels of 19,177. And from there, it's cooled off by close to about 50 points. So once again, it's down close to about 150 points. There you have it. From the day's high, it's about a 200-point fall. Prakash Diwan is now with us on the show. Prakash, what's the origin of this fall? Where is this big selling pressure coming through, the volumes? Because when we looked at that FII, DII number yesterday, both of them were buyers. So what have you picked up from the market in terms of the origins of this selling?
Good afternoon, Rima. So that is a little bit of a question that's been vexing most of us, and we also had an intervening holiday to actually figure out. But this is reminding me again of the September first half fall, 11th or 12th. I'm not too sure. I think it was 12th when we started post facto attributing it to basket selling by one of the FIs, because of certain governance issues. And then it was kind of later on realized that was probably not enough reason to explain that. And then the market moved on. I think what's probably happening is look at the setup which would compel somebody to sell, and then we'll identify potentially who could that be or which segment would be responsible for it. The 3-4 major concerns, beginning with the US 5% yields, is something which has happened after a long time, and it does spook globally everybody to look at that kind of a bearishness on the bonds. The second thing is you also have an election coming, and not just the general elections next year, but the state assembly elections, which will also start setting the tone in a very definitive way, is what people are guessing. And of course, the geopolitical tensions in the Middle East. So there's no respite out of that. So with macros are so difficult to digest. People start looking at the micro movement, and that's where you have a broader market correction that's happening, which was kind of overdue. All of us were talking about it. You look at commentary in the last 4 weeks, every fund manager has come and said that it's time to shift into large caps. So my sense is it's probably a lot of churn that's happening where small caps are getting hammered and people are trying to exit before the results come out. The report cards could be ugly for quite a few of these which have run up way ahead of earnings. And that's where it's kind of spiraling into a little bit of a bearishness. But I would sound contrarian if I were to say that this is a correction that was much awaited, but it's probably happening a bit too sharply for people to accept it. That's the only reality.
Prakash, hi, good afternoon. So the shakeout continues. I guess mid caps. That's where the jitters are. But you tell us, what should the approach be now? And a lot of the selling that we've seen is no surprise. It's taking place in sectors that ran up the most, namely PSUs, as one example. What would your advice be right now? Stay away, let the dust settle, and then figure. And I think the question that people will grapple with is that once all of this settles, will we have a new trade, a new trend, a new sector? Or, can the existing themes last, the existing mid-cap, mega themes that have worked?
So, good afternoon. So, yeah, absolutely right. The sell-offs is from companies. In fact, I'd made a checklist of names which have got beaten down the maximum in the last 4-5 sessions. And this is probably coincidentally or anecdotally timed with the peaking out of the small cap index, right? So let's look at BHALE, which was one of the top names, the heavyweights which have lost, not just small cap names. We were going so gung-ho on the order book position, the kind of build-up, and BHALE is probably off that in a significant way. Now what happens is if you add some of the railway stocks, you add some of the defense names, so order book based, hope-based trades that were building in and valuations were getting stretched is where a lot of these things have started correcting. So my sense is you will probably see that happen, and people at times can't differentiate between what deserves to come down and what doesn't. So this is the time to be very stock specific. So in terms of what should one do, I think it's good old stock picking that will come to your rescue. If you feel that the business models that you've invested in are still intact and there's no let up on earnings, even if the company happens to be a small cap or a mid cap, it doesn't matter. The price would kind of correct upwards at some point, right? So there is a very clear, fear or aversion to buy afresh, and that's why on the other side, when somebody's selling, there's no takers. So earlier, what was happening is everything was getting lapped up, and we've gone through this whole season of promoter selling, PE exits, and which got absorbed. And now what's happening is that some of these stocks which have been very widely distributed are actually not seeing any buyers. So, I mean, good names also are struggling to see buyers. So I think it will continue till you reach a stage where it becomes compellingly attractive. I mean, the market always swings between this fear and greed kind of a scenario, right? So that's probably some time away. But my sense is we are going that way soon.
Manish Singh is also with us. He's CIO at Crossbridge Capital. Manish, good to have you with us here. Good afternoon. So, yeah, I mean, here in India, we are not used to sort of sharp falls. We've not been used to sharp falls for a while. We got one in early September, 12th of September, where broader markets sold off on indices. They sold off 4%, and then things moved on. And over the last 3 or 4 days, I mean, the Nifty, the benchmark has lost about 600 points or so. How would you look at what's going on, and what are the dominating drivers to your mind?
Yeah, I think the cue is going to come from what's happening in the U.S., right? That's the biggest thing that everyone looks at. And over there, the conditions are improving in the way that we are at peak rate. So I find it strange that people who are selling equities, they're selling at peak rates, which makes no sense, because one should be seller if you expect the rates are going to go higher, which was a year ago. So if you look at the 10-year yield, right, it peaked at around 5%, and last 3 days we are seeing the yields are coming down. But more importantly, the PMI number across the board in Europe is bad, 46, 48. In the US, just about holding. We'll get the Q3 GDP data, which probably is going to be around 4%. But regardless, if you look at the underlying, the conditions, the financial conditions are extremely, extremely tight. And I have a feeling that, I know people are not talking about it, but the talk about rate cuts in Jan will come into conversation very soon. And it will not surprise me. I know people are saying rate cuts could be May and June, or maybe 2 rate cuts next year. I think they'll be surprised when rate cuts either happen or people start talking about it in Jan. So my view is very simple, that you're not going to sell equities when the rates are at peak. And if somebody is selling, then I don't know their obligations, why they're doing it, but others should take a 12-month view, and they should be buyer of the good names. I always say buy equities, the good equities that you would buy for regardless of any reason, and those are the things that you should trade, and those are the things you should buy.
Manish, that can be said at any point, right? I mean, rates at 5 or rates at 0. But my point is, when you say rates will perhaps be cut in January, the accompanying backdrop has to be pretty bad, right? For suddenly rates to start to be cut after everything that the Fed has said. Wouldn't the market pay attention to that? That is the logical question. What's your sense?
Okay, so if you look at it two ways, are the rates too tight and too restrictive, which is hurting the economy? And that means you could have rate easing. I'm not predicting that we are going to go back to 0 rates or low rates. I mean, if that happens, then clearly it is happening for a reason that the economy is really bad and the economy cannot take higher rates. I don't think that will be the case. I think there's no reason to keep rates at 0. That is a big, big mistake. And I don't think rates are going to go there. But if you see the rates are going to ease from, let's say, 5% or 5.25, where it is today in the U.S., to 3, I don't think U.S. economy can handle more than 3 if you look at the outstanding debt and everything that's going around. And if you get an easing from 5.25 to, let's say, 4, and your GDP is growing at 3%, I mean, that's like the Goldilocks scenario. Your economy is growing. You ease the rates because you genuinely believe that the rates were just too high, and that should be seen as a positive outcome. If there's a recessionary outcome and the rates are going to go down, yes, that's something you will have to worry about. And then you could have a sharp correction. But then what happens? You've seen through cycles. Recession is the way how you control the excess, and then the demand grows and you buy again. And that's something we are used to in cycles.
Manish, so clearly you are not as pessimistic about the global outlook. You believe that this is the best time, perhaps. This is not the time to sell when we are at peak U.S. interest rates. But what about India? If you had to buy today the Indian markets, which sectors, which themes would you look at? Because we have seen about a 4-5% correction in many stocks.
So I would say that, I don't do much India sector specific, so I can't comment specifically. But if you talk about India as a whole, because we end up doing index mostly when you're looking at the emerging market, then there is absolutely no reason that people should continue to sell. Now, I know it's a difficult argument to make. We know when the market is falling, but again, this is where the difference between a trader or investor comes to mind. I give you an example. Look at what happened in the U.S. Treasury market. If you are a trader and if you put a short trade on U.S. Treasury for 3 months, you will go against the view that rates are going to cut. And then in 3 months, you will unwind the trade. So they will be right in 3 months' time, and I will be right in 12 months' time, the rates are going to go down. So it depends on what is your time horizon of investment. If you're doing a short-term investment using leverage, then you can't take any 5%, 10% correction. But if you're taking a 12-month view, then you can take that risk. So ultimately, it comes down to your trading strategy and what your investment is about. I always look at things from 12 to 24 month point of view, and therefore I feel comfortable. And when I see sell-off in the names that I like to buy. And for India, again, it's a secular growth story. I don't think that changes, regardless of what's happening around the world. And largely, if I make a final point, is that if you see what's happening in the world, and I know it's very easy to get pessimistic when you see red lines and everything, what is happening? The cost of capital is coming down in the emerging market. The inherent growth that is happening is coming from within. I mean, if I look at, I'm based in London, when I look at television ads and things, a lot of things happening on the ground in India which has got nothing to do with what's happening in the US. That is not going to stop. That will continue. And that is the India story that people have to believe in.
No, absolutely. Manish, thank you for joining us and thanks for those views. Prakash, thank you very much for your time. Good speaking with you as well. Short conversation, but we hope we can pick up on some of those points a little later. We're at about 19,150 on the index. We'll take a quick commercial break here. We'll come back. Vinay Jaisingh is going to be with us of JM Financial on the other side. Stay tuned for that conversation.
Welcome back. Well, the good news is that we aren't sliding anymore. Things seem to be stable for what it's worth, 19,150 thereabouts. That's where the market has tried to form some sort of a base, at least for the time being. Let's keep the conversation going. We have our next guest now joining in, Vinay Jaisingh, who's the MD Portfolio Management Services at JM Financial. Vinay, thanks for joining in. Interesting times. It seems that suddenly from going to a consolidating market, a market that's just seeing some time correction, now there's a bit of a worry on the street, specifically with respect to mid caps and small caps. What have you made of the shakeout we've seen over the last 2 days?
A couple of things, Firstly, the shakeout is largely a function of what's happening globally. You've seen the US debt market, you've seen the interest rates there surge to 5%. It's corrected a bit to 4.8 now, the 10-year yield, but you're also seeing interest rates for the longer term inch up in US and remain high for long. Now, this is a 15-year high which US has witnessed. What we're hearing is, be it the mortgage industry in US, be it the student education loans of US, both of them have more than tripled because of what's happening in the interest rates out there. The good news there is the fiscal deficit is increasing, as a result of which you're not seeing the GDP correct. And you have, at one end, a high interest rate environment, at the other hand, the government spending, so you're not seeing as much pain for companies. The concern which has seeped in the last couple of days has been, what if the government of US in the next year starts reducing the fiscal aid which it's giving, or starts increasing the deficit, reducing the deficit? What would happen with that is then the pain would start hitting the companies a lot more. And that concern now, though it's largely US-centric, is revolving to the rest of the world. India, being the best performing market, FYTD, has seen the last few days found it a little tougher to do well on the bourses. They're down 2%. Obviously, the small cap and mid cap, which are up as much as 35% FITD, or a little bit more YTD, they've seen a shave off of almost 3 to 5%. So it's more a correction. In our eyes, it's a healthy correction. This is the time when, when we had put some money which we had saved, let's say 8% out of our portfolio, we got to start looking at what in mid cap, what in small cap, or what in any cap looks attractive. Now that yield of interest which you had in the small and mid cap, the dividend yield is not different compared to the large cap. So for us now, it's just individual stocks. We like the capex sector, so individual stocks, be it in small, mid, or large, we start nibbling in, or wait a little bit more for corrections. So for us, really the view is don't look at any caps as of now. But don't forget, India is really doing very well on the earnings front. Whatever results we've come apart from rural India, your earnings growth trajectory is still on the 15% plus mark year on year. That sounds great. Also, don't forget the dollars which India has, the forex reserves are pretty strong. So overall, apart from the current account deficit, things look a lot more robust for India compared to the rest of the world.
You mentioned rural. Vinay, hi, good afternoon. Look at levers. I think volume growth for the last 3 years, I think no volume growth, right? But,
absolutely.
But so, again, in rural, you got to, I guess, pick pockets. So what are you adding to what you already own? Because I have a bunch of things that you do own. Are you looking at newer things? Just give us a flavor, Vinay.
Sure. So we largely, we are negative on rural. As you said, our levers results have not been as good as we wanted it to be. We are not seeing a volume growth of more than 2-3%. So we're keeping our eyes open in the rural space. But what we are adding to are, companies in the capex sector, which have partly corrected, but the results are pretty exciting. Be it companies like Kirloskar Oil, be it companies like Vatek Wabag, wherein the earnings as well as the valuation is going your way. We're looking at some pharma names like Concor Biotech, which is very resilient again to earnings for the rest of the world, because it's a market leader both in global as well as domestic. Domestically, it has a market share of 40 to 50% in immunosuppressant. So these are the names we are looking at. One company in the financial space where we are looking, and we've added a weightage a lot in the financial space in the large cap, but in the mid cap or micro cap is Fusion, a good MFI with a 5% plus ROA. So I think there are lots of good names where the earnings growth trajectory are rock solid, and those are the names we are focused on. Also, this is the time wherein we think valuations in some stocks have hit the roof. We are correcting some of them. Some risks which we see from China, we've reduced a little bit of position in a specialty chemical space. So, we have a kitty of 8 to 10% to invest.
So, 8 to 10% to invest. Is this the most that you've kept in the recent past? Would you look to up your cash exposure?
Even in the last month, we had a similar kitty, but, we took out some specialty chemical names and bought some. So it's more or less been at the same level. We don't like going north of 10%. So it's close to the most we would keep as cash in hand.
Okay. Vinay, so you mentioned, for instance, you're a little cautious in areas like chemicals, and that's completely understandable given the way a lot of the global companies have been pruning their guidance, right? If you were to start shopping in this fall, first of all, is it time, or should one still wait it out and let things settle? But if you were to go out with your shopping list, what areas are you looking at now? Specifically, I'm talking about mid caps and small caps.
Right. So, let's start with the chemical space first in mid caps and small caps. Though we say chemicals as a whole basket, you got to look at those chemicals which are not linked to China, where China is not producing the product or the raw material. And then you will get companies like, let's say, Tatva Chintan, which actually are selling products to China for their CV, which are also tomorrow's story for EV. They're also focused on flame retardant. So, some spaces out there. In CapEx, when we are looking at railways, we've got interesting order books growing for lots of companies. I think that entire sector, if you see any correction, you got to choose any of the picks. All of them have earnings growth trajectory of 25 to 30%. All of them happen to be mid cap or small cap. In defense as well, you will see earnings of some of the companies not being as attractive, largely because they've not got the supplies from the rest of the world to finally send the products. But companies like Bharat Dynamics, their order book is real. They have to execute. It's a matter of whether it executes this quarter or next quarter. The return ratios are rock solid at about 20%. So if they miss 1 or 2 quarters earnings, what that means is in the next 3 years, the earnings growth could be as much as 45 to 50%. So there are enough of mid and small cap names, which we are looking at.
Vinay, have you looked at Dreamfolks as a business? I think...
No, sorry.
No, you're not. Okay, I just wanted your thoughts on Fusion. You own that. You mentioned that. It's kind of not done very much for the last at least couple of months. Even of course had a big run earlier. Is that the best name in the microfinance space, or is it the cheapest with the best growth? Is the valuation growth combination, or many like Credit Access for a very high quality MFI again? But your thoughts?
So I think, as you said, it's more a function of the best value for money. It's trading at 1.7 times price to book, 5% ROA. It's had a historic loan book growth of about 35%. And, our analyst tells us a 25% growth rate in the next 3 years is something which she's very comfortable at. Also, the capital adequacy ratio is north of 23-24%. So they don't need to come to the market to raise rates. So this is something which I think on a risk-adjusted basis makes a lot more sense for us than most of the other MFI names.
Okay, got that. We'll leave it there, Vinay, for now. Appreciate you joining in with that perspective. Thank you very much for joining us, and happy shopping. I was mentioning Dreamfolks. Dreamfolks, if you look at the price, it basically had a very sharp fall, almost a vertical fall from 800 to 500 rupee levels after the last quarter results, the first quarter results. Has it bottomed out? Time will tell. But numbers came earlier today, and numbers for Dreamfolks do look pretty good. So revenues, I think, are up 65%. EBITDA is up 22%. Profit after tax is up 32%. I think there is a conference call later today, but that is something to keep an eye. Something which has actually completely fallen sharply, and the numbers are looking good in this particular quarter. So that's something on the radar. We'll take a quick commercial break here. The market's still down 140, 150, 19,130 or so on the index. We'll take a quick commercial break here. We'll back what's happening in dealing rooms. I mean, interesting to hear that chatter today with Nimesh. That's coming up in just a bit. And of course, our short-term trading ideas after that. Stay with us.
Welcome back. It's time now to get a sense of what dealing rooms is saying with today's fall, carnage in the broader markets and individual stocks. This is D Street Chatter. Nimesh is with us. Nimesh.
Hi, Rima. So, market at the day's low, and again, this is backed by good institutional activity as well. I'll come to that, but largely it's a technical-driven sell-off. I understand a close below 19,180 could further trigger further sell-off in the broader market. So 19,250 was a big level to watch out on Monday's trade. Once that got cleaned out, we saw a sharp sell-off, and now the today's level to watch will be 19,180. We're still below those levels, so watch out for that in the last 15-20 minutes of trade. As I said, unlike Monday, today the sell-off is backed by institutional activity as well. So the volumes are on the higher side, and the FI flows are largely on the sell side. In fact, what I've picked up is that there is a buzz of a liquidation of an India portfolio by a leading hedge fund. So that added to the pressure, at least in the first half of today's trade. The sector which is under pressure today is clearly the PSUs. Within the PSUs, across the board, there is selling pressure, whether it's the PSU banks, whether it's PSU defense companies, all are under pressure today. And again, the sense is this is one sector which has been a rank outperformer, so there is a bit of profit booking now. And again, the tendency from the investors is largely they try to sell the good portfolio to protect their bad one. So that's simply playing out in the PSUs today. The only sector which has seen a bit of an uptake is the metal names. Not sure what the buzz is. Maybe some people are anticipating some sort of a package from China to help the metal names. But there is buying as well in the metal stocks today.
Okay, all right, Nimesh. In terms of individual stocks, what's on your list today?
Well, the first stock on my list today, Prashant, is Swan Energy. It was part of my deal sheet chat a couple of days back. 3% equity got changed hands. Could be more in the works, but in today's block, I understand a few large HNI investors and a couple of domestic mutual funds were buyer in today's block. So that's the first one. The second stock is Mac Power CNC. Big mover in a weak market. On Monday, the stock was locked at 20% upper circuit. Today, the stock is up 15% and on good volumes as well. Remember, the second quarter is quite strong for the company, which came over the weekend. I understand some large HNI investors are quite active in the stock, and a peer listing is on the card. So maybe that's also keeping the stock excited. The new company which is going to get listed is coming at a double the valuation. So that's the reason why that stock is buzzing in trade today. The third is combination of both the PSU defense names, Hindustan Aeronautics and BEL. Both the stocks are under pressure today and largely on back of sell flows. So expect high delivery volumes, and there is now clear selling pressure from larger FIs into both the defense names. And the last one is Hindalco. I spoke about metals generally doing good today, but Hindalco stands out purely on back of strong buy flows. So some bit of FI delivery buying is back in Hindalco in today's trade.
Okay, thank you very much for that. There are a few stocks which is bucking the overall negativity. So Welspun India, 10% higher on that, post their numbers. IFL Securities has been strong for the last couple of trading sessions. So today it's rallied close to about 6.5%, but it's been popping up on our charts on the volume front too. PSU Bank, so IOB is up 4.5%. UCO Bank has gained 2.5%. Central Bank of India is up close to about 2%. So that pocket of the market is still holding up. And you also have Geo Financial, which has moved up on pretty large volumes. Mitesh is back with us for a few BTST calls. Mitesh.
See, I think, I would suggest STBT, despite the fact that I believe that we are oversold. I think, the trend is on the downside. So till that changes, we'll continue trading with that. And STBT and Aurobindo Pharma with a stop at about 869 for a target of around 850 on the downside. And the other one will be STBT and Bajaj Finance with a stop at about 77.30 for a target of around 76.30.
Okay. 2 STBTs, right, Mitesh?
That's right.
Okay. Got it. So you're not expecting a big flourish of an opening tomorrow? Unlikely.
Well, see, I think, again, it's a very difficult call to take. I don't know how the news flow in US markets will play out. In fact, Prashant, this is the market when I'm not very aggressive on STBT calls because very clearly not the best of the time. You've already fallen and then you're in...
Correct, exactly. Yeah, no, exactly. So yeah. But in any case, right, I mean, both sides keep tight, stops very tight, and be nimble if you are indeed trading, as Mitesh also has been pointing out. Well, let's shift our focus to the Nifty companies that will be reporting numbers as we go forward. So let's start with Axis Bank, which is first on the radar. Abhishek is here with expectations. Abhishek.
Well, Prashant, Axis Bank, as per our poll, the earnings are expected to be under pressure with a decline in net interest margin seen. So the key things to watch is that the loan growth is expected to be around 20% YOY and about 3% quarter-on-quarter. Loan growth will be aided by the high-yielding asset in the overall loan mix. A net interest margin can come under pressure, which is like the scenario that you are seeing for the entire banking sector. So Kotak Securities estimates a 5 basis point decline in net interest margin compared to what we have seen anywhere between 25 to 40 basis points for other banks as well. Kotak Securities estimates a treasury loss in Q2. This can actually drag the overall operating profit growth as well. Slippages are largely expected to remain stable quarter on quarter. We have the likes of Kotak Securities again estimating a 4,200 crore slippage, while ICICI Securities is estimating about 3,500 crores. In the previous quarter, the slippages were close to about 4,000 crore. So asset quality will remain stable. Again, Motilal Oswal has an estimate of gross NPA being at 2% versus 2% in the previous quarter, net NPA being at 0.4% versus 0.4% in the previous quarter. Commentary with respect to loan growth and net interest margin momentum going ahead will be seen very closely. Our polls suggest NII growth of 15.5% YOY and flat on a sequential basis. We are working with a profit growth of 7.6% YOY and a decline of little more than 1% quarter on quarter. Back to you.
Thank you very much for that. The other one we'll be watching is Tech Mahindra. The press conference is scheduled at 3:45. So numbers should be out immediately as the market closes. It's expected to be a subdued quarter. So on the top line, we're expecting a revenue decline. And this would be the second consecutive quarter where revenues for the company have fallen. The problem is their communication vertical. That's about 40% of their overall revenue, where clients are cutting down on their spends. So tech budgets, particularly for the communications sector, have been under pressure. Even peers so far who've reported numbers have seen the communication vertical see weakness. And for Tech Mahindra in the last quarter, the communication revenues had fallen by more than 9% on a quarter-on-quarter basis. Margins then. Margins are likely to remain subdued, maybe on the flatter side. Last quarter, there was an impact of a bankruptcy of a client. But this time, margins could be impacted by the organizational restructuring, but we'll have to wait by. The key for the company is not going to be so much about numbers and a little bit of a percentage point here and there. There is a new CEO on board. He's a CEO designate, Mohit Joshi. And the hope is that under him, Tech Mahindra can resurrect a turnaround because revenues and margins for the company are trading below their normal levels, historical levels of Tech Mahindra, and much lower than peers. So take, for instance, the margins. For Tech Mahindra, margins are about 6.5% in the last quarter, but they have been weak. Historically, Tech Mahindra would trade at 14-15% margins. Peers like Infosys, TCS are above 20%. So there is a long runway, a big headroom for them to improve their margins. So the street is actually going to be watching out for the strategy under Mohit Joshi, on how he can turn around, improve the growth prospects, and at least the low-hanging fruit is improve the margins from here on. As I said, numbers will be out post-market hours. Get into a break on that note. On the other side, we'll invite Anand Tandon on the show.
Okay, welcome back. There's just, I think 10 minutes to go for market closing. Less than that, 170 lower. Any hopes of a big recovery, etc., not quite panning out, just around 19,100 once again. Anand Tandon is with us, of course, to run us through what he's making of the correction. Anand, the common refrain is that this was coming. Many were expecting it, but was not happening. So kind of everybody got onto the up and up bandwagon, and perhaps that still will come through. It'll play out in the longer run, but for now we've got to deal with this corrective phase. Your thoughts?
Well, that's right. But the question is, the only way one could have arranged, reduce the damage to the portfolio would have been to get out of the small cap, which is something that I've been arguing for a while. There is a simple correlation that you will see whenever the markets tighten, and the RBI, for example, has been looking at tightening the liquidity available in the markets. The surplus liquidity has been falling, and they have done enough to make sure that you don't get too much of money. So when I'm talking about liquidity, it's not only stock market liquidity, but general money availability. Then the small cap and mid cap start to fall, even when valuations are not very high. And we have at this stage a question where the small cap, mid cap valuations are higher than the front line. And we all know that liquidity is low, so whenever there is a rush to the exit gate is too narrow, and you will end up getting trampled. So that was the only assumption that was reasonable to make at this stage, that with everything being okay, the small mid cap valuations being where they were, you should have moved to the large cap. Not that that will necessarily reduce not that it will stop your portfolio from bleeding, just that the bleed will be lower, and hopefully you'll be in better quality stocks which will recover faster. And I think that still remains a valid strategy at this stage.
Anand, afternoon. Have you used this weakness in the markets to buy into any stocks, themes that you like? Because you've always maintained, right, the markets are overvalued, it's difficult to find value. Now you're getting some stocks 10-15% lower in a span of 5 days. Have you used this opportunity, or are you still going to wait it out?
I think I will still wait. I think it's not. So my portfolio is not a trading portfolio, so I don't particularly care whether I buy. I don't try to time it to the perfection. So therefore, it's a question of waiting for the markets to fall, seeing how far they go. It's difficult to predict how far it will go, and then when there is a bounce from there is when you actually look to buy. In my view, the near term may look a little oversold, but if you look at where the US market is or the international markets are, my belief continues to remain interest rates are way too low. They are not peaked out. They will not start to fall anytime soon. In fact, there has to be a further rise in the interest rates given the kind of global debt that we are facing. And the debt is humongous. One has to just look at the numbers to see what that means. So there is no question that money will get more expensive globally. And I don't see how India can be an exception to the rule. And in that kind of situation, we'll have to see the most robust companies which have strong earnings and the ability to sustain when the consumer itself suffers from a higher interest rate. So that's the scenario one is looking for. I'm in no hurry to be rushing to buy.
No hurry to rush in. By the way, for the broader market, it is not, it's 10-1 still. I mean, actually, even today, I think the market breadth is pretty poor, pretty negative. But there's a fairly long list of decent volume-led gainers today. Some of these sugar stocks like nuclear software, KDDL, which is basically Kamla Dials, but, Bombay Stock Exchange is at 1800, Indian Overseas Bank, Wonderla is up about 7% or so, Bajaj Consumer, Angel One, Amber. There is, it's not all down and out, even though, the market is under pressure. And compared to Monday, the cut in the broader markets is not as severe. Mid-cap index is down 0.6%. The Nifty, for example, is down more. It's down 0.8%. And I think the small-cap index was down even less. So, actually, it's down just about 0.25% or so, the Nifty small-cap index. But I think it's after a very long time that the small-cap index is down 3 days in a row. I mean, the small-cap index has been perhaps one of the strongest indices in the world over the last many months. And we've not had 3 straight days of losses, but we have it today with this 0.25% cut today. And, of course, Monday's large fall as well. Any thoughts on names like Bombay Stock Exchange, Anand?
Well, too much is being made of the kind of volume growth one is expecting from options. I saw an analyst report which put out a figure of the profits going up to 500 crores in a couple of years from now. Let us assume that that is possible. You are still looking at 50 times, 60 times earnings with that kind of forecast, which itself is 3 times as much. So while you could argue that it's a monopolistic or a duopolistic situation, and therefore that kind of valuation may be you may have to pay a little more for the thing. I would typically find that regulated entities are not necessarily the best ways of playing for the market growth. If you're really looking for playing for market growth, there are various ways of doing it. You could buy the brokerages, the registrars, and the asset management companies. Off the lot, my own preference would be to buy asset managers when they are cheaper.
Anand, thank you very much for joining in, coming to the close of what's been a painful, difficult session for our markets. We're not closing at the day's low, but we're closing pretty close to that. The Nifty's just managed to defend that 19,100. Right now, it's 19,118. We're staring at a cut of more than 150 points on the Nifty, while the sensex has seen a fall of close to about 300 points. The advanced decline ratio is quite weak. The mid-cap, small-cap, all of them have succumbed to selling pressure. In terms of the big movers, Infosys is the top loser. It's down 2.5%, but again, impacted by the fact that it's gone ex-dividend. Pharma has been weak. Apollo Hospitals, Cipla, Divi's Laboratory. Bharti Airtel cracked close to about 1.5%. Eicher Motors was down 1.7%. NTPC weak in trade. Gainers list has a few of these metal names, like Tata Steel, Hindalco. Tata Consumer too up.
Tata Steel as well. So metals basically as a pack was doing well. Just a few more names before we kind of wrap up. So, these are the largest volume-led losses in the broader market. So, Cochin Shipyard will come up on your screen. Sharp cut. HEG, large volumes and lost about 6% or so. Bector Foods will come up on your screen. Data Patterns is another one. There's Fusion Microfinance. Vinay Jaisingh of JM was earlier talking about Fusion. There's Jubilant Pharma, second day in a row, sharp cuts. MMTC, of course, we've been talking about this one. Safari, the luggage maker. PG Electroplast, Repco Home. These are some of the large volume-led losers. But there are winners as well, and a fair number. So Bombay Stock Exchange, BSE, almost at 1,800 today. Indian Overseas Bank sharply higher. That's BSE and IOB. Welspun Industries basically recouped Monday's sharp loss and actually closed higher. Very positive signal price action-wise on Welspun Industries. Delta Corp was higher. Amber Industries recovered after Monday's sharp fall. And there's Angel One, which went up about 4% or so as well. Some of the others like Wonderla, KDDL, Sequent Scientific, Bajaj Consumer, we've been highlighting, but some of these other names are part of the list as well. So that's that. Another down day, but this time I think what's different is that the broader market sold off and did better. They were down, but they were down less as compared to what the Nifty lost in terms of trade today. The small cap index actually losing the least amongst the top 4 indices. Well, that's a wrap on this edition of Closing Bell, but don't go anywhere because our special offering, Financial Quotient, comes up next in just a bit from now. Stay with us.